Now, again, question would come to mind, what is annual value? Now, annual value measures the potential, the caliber, or the capacity of the house to generate the income to the owner. Now, whatever income can be generated by a house is known as annual value. Annual value measures the potential income of a house property. Now, whether it is being generated or whether it is not being generated, that is not the concern. House may be let out, house may not be let out. Still, it may be taxable. Now, for that matter, we will calculate the annual value of the property. Annual value of the property would be taxable in the hands of the owner of the house. The person has to be owner of the house. He may be registered owner or he may be deemed owner, but he has to be the owner of the house. But there is one condition. If the owner of the house has occupied the house for the purpose of carrying on his own business and profession, then this income cannot be taxed under the head income from house property. That means to say, the owner of the house, if he occupies his own house for the purpose of carrying on his own business and profession, then this house cannot be taxed under the head income from house property. Then income from such house can be taxed under the head business and profession or income from other sources, but cannot be taxed under the head income from house property. Now, this is the brief preview of the income from house property, and you might have already studied the entire chapter in detail, and you might be having some queries which you can ask me later on. Now, the third heading or the third head of income is called PGBP, that is profits and gains of business and profession. Now, what is taxable under the head profits and gains of business and profession? As the name suggests, we would tax any income which is through business or profession to a person. It includes income from business as well as income from profession. This income may be direct income, may be indirect income. This income may be speculative income, may be non-speculative income. This income can be generated by doing something or by not doing something. This income could be in the form of the export incentives which are given by the government, or this income could be in the form of the perquisites. This income could be in the form of the benefits, or this income could be in the form of gifts which are provided by the customer or clients to the businessman. Now, from this income, the expenses which are incurred by the assessee for running such business and profession would be provided as deduction. So that means to say the entire income is not taxable. From such income, we have to deduct the expenses which are related to earning of such income, and only the net income would be taxable under the head business and profession. Now, the fourth part or the fourth head of the income is, it is called income under the head capital gains. Now, what is income under the head capital gains? Whenever any person transfers any capital asset during the previous year, and because of transfer of this capital asset, some profit or loss, some profit or gain, loss is also the form of income, but it is negative income. Now, if any profit or gain arises to any person on the transfer of the capital asset during the previous year, it would be taxable under the head capital gains. And it would be taxable, normal rule is, transfer takes place in the previous year, gain arises in the previous year, normal rule is, it is taxable in the relevant assessment year, that is in the next year. However, in certain cases, the transfer might take place in the previous year, but the gain would be taxable not in the assessment year, but in certain different years, and these are called special cases or special situations, which we might have studied in chapter, like conversion of capital asset into stock in trade or compulsory acquisition of asset. So these are certain areas where the taxation may be postponed to the different years rather than assessment year. Now, capital gain is tax on the profit or gain on the transfer of capital asset which took place in the previous year and would be taxable in the assessment year. You know the definition of the term capital asset. It's a wide definition. What all is included in capital asset? Capital asset includes all kinds of assets, whether tangible or intangible, whether fixed or circulating, whether movable or immovable. All assets are capital assets. However, there are 6 exceptions to the term capital asset. There are 6 items which are not included in the term capital asset. I hope you might have studied in your syllabus thoroughly, all those assets which are not included in the definition of the term capital asset, such as stock in trade, or like the raw material which is used for the business, or the personal goods or personal movable assets which you use for the day-to-day purposes, or agriculture land which is situated in rural area, or we might have like special bearer bonds or national defense bonds or gold deposit bonds. So these are the different kinds of basically assets which are not included in the definition of the term capital asset. So this gain is known as capital gain, which is divided into 2 parts: long-term capital gain and short-term capital gain. Again, long-term and short-term capital gain, how do we calculate, and why this gain is divided into this long-term and short-term capital gain? I hope you might have studied in the detail in the syllabus. Any doubt about that, we can take later on. The last head I would like to discuss with you is called income from other sources. Now, income from other sources, charging section is 56, and it has got 2 subsections, section 56(1) and section 56(2). Section 56, subsection 2. Section 56, subsection 2 includes 9 specific incomes, such as interest on securities, dividend, lottery or horse races income, etc., etc. These are 9 specific incomes which are included in section 56(2). These 9 specific incomes, along with all the residual incomes which would come in section 56, subsection 1. Residual income means those income which are not included in the previous 4 heads and which are not included in section 56(2). All these remaining incomes would be included under the head section 56(1). And all these incomes are taxable under the head income from other sources. Example of income which are covered under section 56(1), residual income, you can say like salary given to a member of parliament, or family pension received by a widow of a employee, or royalty income, or interest, bank interest, etc., etc. There is a huge list of all these items which would be included in section 56(1). So all these 5 heads which we have, once we divide the income in these 5 different categories, a person might have income under that salary, person might have income under the head, house property or business or profession or capital gain. We add them together. Income of these 5 heads in respect of a particular person for a particular previous year is added together. And sum total of all these incomes is known as gross total income. From the gross total income, we allow certain tax incentives or tax deductions which are covered by the chapter 6A of the Income Tax Act. Why these incentives, why these benefits, or why these deductions are given by the government? Because whatever welfare activities, whatever activities for the development of the country government wants to perform, they might not have the funds, sufficient funds for that. So government wants that the persons who are earning the income, they should make certain investments, they should make certain savings out of their income in certain specified areas. And if they do so, they put their some part of their money, they save their some part of their money into those specified areas which are given in chapter 6A, then government provides them with an incentive by not taxing such investments or by not taxing such income. Now, for an example, if a person has earned the income of 5 lakh rupee in a year, his gross total income is 5 lakh. Out of that, he invests 1 lakh in those areas which are specified in chapter 6A, that is section 80C to 80U. Then from the gross total income, this 1 lakh rupee will be deducted. Remaining portion would be 4 lakh, and 4 lakh is the amount which is known as total income or taxable income. On such income, the government would be charging the taxes. So, the tax is on the total income of the person. Now you know what is total income. It is the sum total of all the 5 heads of income, which is gross total income. From there we allow the deduction. The remaining portion is known as total income. Now, if we want, we can go into the detail of each and every chapter, and it is a long process. You might have studied over a period of 6 months, 1 year about the entire taxation law. But it is, since we have the limited time, so we can't discuss the entire length and breadth of all the chapters. However, now switching over from the Income Tax Act, now I would like to come to the Wealth Tax Act. Now, under the Wealth Tax Act, what we have to do, what are the all areas which we have to cover? Briefly, I will provide the overview of that also. Wealth Tax Act's charging sections, which is section 3, it mentions that wealth tax is a tax on the net wealth. Wealth tax is a tax on net wealth. What is net wealth? I'll discuss a little bit later. Of the person. Who is person? For wealth tax purpose, the person includes only 3 persons. That is individual. Number 1 is individual. Number 2 is Hindu undivided family. And number 3 is company. But as far as Hindu undivided family is concerned, Hindu undivided family which is covered by the Mitakshara law, only that HUF is covered. If the HUF is governed by the Daya Bhagya law, that is not covered under the Wealth Tax Act. Now, 3 persons are individual, HUF and company. These are the 3 persons which are liable to the wealth tax, and wealth tax is levied on the net wealth of the person. Now, let's come to the point, what is net wealth? Net wealth means whatever taxable asset a person owns on the last day of the previous year, which is known as valuation date, now, net wealth is to be computed on the last day of the previous year, which is last day of the previous year, now which is known as valuation date. For calculating net wealth, we have to take all the taxable assets which are owned by the person. From that, we have to deduct the corresponding liabilities which the person has created for acquiring such assets, which are known as debt owed. If we deduct the debt owed from the value of the taxable assets, this is known as net wealth. On such net wealth, there is a threshold limit. If the net wealth of the person is up to 30 lakh, there is no tax. If a person owns net wealth more than 30 lakhs, the excess of the net wealth over 30 lakh is taxable at the rate of 1%. Now, net wealth of the person would be computed up to 30 lakh, there is no tax. Any net wealth beyond 30 lakh is taxable at the rate of 1%. Now, you know the basic concept of the wealth tax. We have to understand, in detail how the net wealth is computed, and the most important area of the wealth tax is what all assets are included, what all assets are taxable under the wealth tax. There are only 6 assets which are taxable under the Wealth Tax Act, and I hope you are aware of these 6 assets. Now, Wealth Tax Act is basically, we can divide the syllabus of the Wealth Tax Act in 3 parts. First part, which covers the basic definition, such as like basis of charge, section 3. Then we have like what is valuation date, what is net wealth, what is the definition of the term asset, section 2EA. Then like what is the basis of charge of wealth tax, like a person might be having a wealth in India as well as abroad. Now the question arises, which wealth is taxable in India? Indian wealth, foreign wealth, or both? That is called scope of taxation of the wealth tax. Just like in Income Tax Act we have residential status and we determine the scope of taxation of income in India. Similarly in the wealth tax, which wealth is taxable in India? So up to this portion we may cover in the first part. Second portion is section 4 and section 5 of the Wealth Tax Act, which is deemed assets or which is exempted asset. Section 4 deemed asset, section 5 exempted asset. So these are the two parts of Wealth Tax Act. Third part of the Wealth Tax Act is the valuation of the assets. For the purpose of taxation or for the purpose of taxation of the wealth tax, we need to find out the value of the asset, which is covered by the Schedule 3, Part B to Part G, Rule 3 to Rule 20 of the Wealth Tax Act. So you can divide the wealth tax syllabus into the three parts. First part covers the basic definition. Second part covers the deemed assets and exempted asset, and last part covers the valuation rules. I hope you would cover them in detail. Remember that wealth tax is an important portion of our syllabus, be it old paper of tax laws or be it the new paper of tax laws and